Markets opening a bit lower this morning over more concerns out of Russia, but what's the VIX telling us about a potential rally in March? That's today on 3 Minutes of Markets and Money. If we go back and look at March of 2020 as an example of when real fear was impacting the market, now remember, this is when we shut down the economy. Markets were doing just fine in January and February. Only minor concerns about this pandemic that was occurring in China. And then all of a sudden, it came to the U.S. and volatility spiked sharply out of this previous very narrow channel that we were in. Volatility ran running off to the moon here over concerns about market stability. And that was really the big issue. If we take a look at the recent environment, despite the fact that we've had a 10% correction in the markets over the last 2 months, lots of sell-off, concerns over the Federal Reserve hiking interest rates, concerns about less liquidity in the markets, concerns about geopolitical risk, Russia invading Ukraine. Yes, volatility has risen, but really only mildly so. I mean, this really isn't the type of spike in volatility that suggests that we are really moving into a bear market of consequence. However, what it does suggest is that markets are getting oversold here. Sentiment is very negative, and typically when we've had these types of kind of moderate spikes in volatility index, again, nothing dramatic, just a pickup in volatility, generally that leads to a short-term bottom in markets and we see a subsequent rally. Now, that wouldn't be surprising at all. After 2 months of negative returns, we have established a fairly decent downtrend channel in the markets. Markets are getting very oversold here and actually have been. And not surprisingly, given the fact that we've got Russia invading the Ukraine, markets have actually held up very well here. And in fact, continue to kind of rebuild this base going back to October lows. So despite the fact that we have all these concerns about the Fed tightening interest rates and monetary policy being reduced, we've got Russia invading Ukraine, the concerns about inflation and high oil prices, markets are holding up here remarkably well. We have more stocks at 52-week lows on the NASDAQ than we had at any previous period over the last 30 years. Again, sentiment very negative. Smart money versus dumb money as at levels that are normally consistent with a short-term market bottom. Now, I'm not talking about the next great bull market rally, absolutely not, but a reflexive rally here on any type of positive news, a withdrawal of Russia for some reason, a more dovish than expected Federal Reserve, is certainly going to provide the catalyst for a short-term rally in the markets. A rally in the markets of 1% to 2% for the month of March would not be surprising, and that would give you a better opportunity to rebalance risk as we move further into the year, because the Fed is going to hike interest rates and reduce monetary accommodation. Historically, they always do that to the point that creates a recession and a bigger bear market. So a March rally here certainly doesn't negate the probability of a bear market. It just means that very likely where we are now, we are due for a short-term reflexive rally to allow you to rebalance risk in your portfolio. That's 3 minutes on markets and money today. Be back tomorrow.